There is a moment that every person who has ever loved Las Vegas can point to. Not a date on a calendar, not a specific event that made the news. Just a moment, personal and quiet, that happened sometime in the last 15 years when you walked through the doors of a casino you had visited before and felt something was different. You couldn't name it immediately. The lights were still there, the sounds were still there. The carpet was still ugly in the specific, intentional way. Las Vegas casino carpets have always been ugly, designed by psychologists to keep your eyes up and your attention on the machines. Everything looked the same, but something in the air had changed. Some quality of the atmosphere, some texture of the experience, some invisible thing that you couldn't articulate but could feel in the way you feel a room that used to be full of people and now isn't. The warmth was gone. The sense that the building was glad you were there, genuinely, specifically glad, not in the way a sign at a shopping mall is glad you're there, but in the way a host is glad when a guest arrives, had been replaced by something mechanical, something efficient. Something that processed you the way an airport processes a passenger, competently and without any pretense that the transaction involves human beings who have feelings about each other. Most people who experience that moment blame the prices, or the fees, or the odds. All of those things are real, and all of them are part of the story, but they are symptoms, not the disease. The prices and the fees and the degraded odds are the things you can see and measure and complain about on Reddit. What actually happened in Las Vegas, what actually caused the soul of the city to evacuate the premises, is something deeper and more structural and far less visible. It is a story about ownership, about who actually owns the buildings where you gamble, who owns the companies that operate those buildings, what those owners want from the asset, and how the answers to those questions determine everything about the experience you have when you walk through the doors. It is a story about what happens when the people who make the decisions about how a casino treats its customers are people who have never sat at a blackjack table in their lives, who live in offices in New York and London and Riyadh, who measure the performance of their investment in basis points and internal rates of return, and for whom the question of whether a player in Las Vegas feels respected is not a cultural consideration, but a cost-benefit calculation that comes out differently every time the interest rate environment changes. This is the story of how Wall Street bought Las Vegas, how private equity firms and real estate investment trusts and sovereign wealth funds acquired the buildings, the brands, and the balance sheets of the institutions that built the modern casino industry, and how that acquisition process, executed across roughly 2 decades of deals and restructurings and bankruptcies and recapitalizations, systematically destroyed the relationship between the casino and the player that had made Las Vegas the most successful entertainment destination in the history of the world. This is the story behind the story. The story that explains why the handshake disappeared and why the spreadsheet arrived and why the free drinks got automated and why the parking costs $30 and why the blackjack tables pay $6 to $5 and why the resort fees are $45 and why, when you call the front desk of a 5-star casino on the Las Vegas Strip, the phone rings in a call center somewhere that is not Las Vegas. My name is Florian, this is Flick, and if you want to understand what killed the soul of Las Vegas, you have to go back before the private equity era. You have to go back to where the soul came from in the first place, because you cannot understand what was lost without understanding what existed before it was lost. The original soul of Las Vegas was not, despite the mythology, the mob. The mob era is romanticized, precisely because it has been filtered through Martin Scorsese films and Frank Sinatra records and 50 years of nostalgia, but the operational reality of mob-controlled Las Vegas was messier and more violent and less charming than the legend suggests. What the mob era did produce, almost accidentally, was a specific and highly functional philosophy of customer relations. The casino operators of the 1950s, 1960s, and 1970s understood something about the gambling business that is now taught in business school case studies, but was then just common sense. The only way to make money over the long run in a casino is to make sure the customers keep coming back. The house edge guarantees that if you play long enough, the house wins. So the operator's job is not to maximize extraction from any individual visit, it is to maximize the number of visits. to keep the customer so happy, so well fed, so comfortable, so valued that they come back every month, every quarter, every year for decades. The complimentary room, the free meal, the discounted show was not charity. It was a retention strategy. It was the mechanism that turned a one-time visitor into a lifetime customer, and the people who ran the early Las Vegas casinos were skilled at deploying it intuitively, from a deep personal understanding of what it felt like to be a gambler who wanted to feel important. The corporate era that replaced the mob era in the 1980s and 1990s professionalized this intuition. Steve Wynn, who is the single most important figure in the transformation of Las Vegas into a modern luxury destination, understood that you could take the instinctive hospitality of the original casino culture, add architectural grandeur and genuine luxury and impeccable service standards, and create something that would attract not just gamblers but the entire spectrum of leisure travel. The Mirage, which opened in 1989, was the first Las Vegas casino to cost over $1 billion to build, and it was also the first to prove that a casino could be a destination in itself, that people would come to see the white tigers and the volcano even if they were not primarily gamblers. The Bellagio, which followed in 1998, raised the standard again with its Italian marble and its art gallery and its choreographed fountain show and its Michelin-level dining. And it was financed in part by a junk bond structure that required Wynn's company, Mirage Resorts, to generate enormous cash flow from the casino floor to service the debt. That junk bond structure was the original sin. It introduced the logic of high-leverage finance to Las Vegas real estate and demonstrated that if you were willing to bet the building on the theory that the revenue would service the debt, you could construct things that no one else could afford to build. Kurt Kerkorian was doing the same thing with the MGM brand. Jay Sarno had done it earlier with Caesar's Palace. The principle was consistent: borrow heavily, build magnificently, charge the floor to pay the bonds. It worked brilliantly and repeatedly until it didn't. The moment it started not working was 2008. The financial crisis that began with the collapse of the American mortgage market and spread across global credit markets with terrifying speed hit Las Vegas with particular ferocity because Las Vegas is, at its economic core, a discretionary spending city. People come to Vegas to spend money they don't have to spend. When the credit markets froze and unemployment rose and consumer confidence collapsed, the first thing American households cut was the Vegas trip. Revenue on the Strip fell sharply. The casino companies, most of which were carrying substantial debt loads from years of aggressive construction and expansion, suddenly found themselves trying to service those debts on sharply reduced revenue. Some of them made it through with difficulty. One of them did not. Caesars Entertainment, at the time, still operating under the Harrah's name, had been taken private in a leveraged buyout in 2008 by two of the most powerful private equity firms in the world, Apollo Global Management and TPG Capital. The deal valued the company at approximately $30 billion and was financed primarily with debt, meaning that the private equity firms acquired a casino empire by using that empire's own future revenues as collateral for the loans that paid for it. This is the fundamental mechanic of a leveraged buyout, and it is worth understanding clearly because it is the mechanism by which private equity transforms a hospitality business into a debt servicing vehicle. You borrow money to buy the company. The company now has to earn enough to pay back the money you borrowed. Every dollar that goes to debt service is a dollar that does not go to free drinks, or comped rooms, or lounge renovations, or retaining experienced hosts, or maintaining the quality of the buffet. The business is the same, the customers are the same, the casinos are the same, but the financial obligation that sits on top of the business changes everything about what decisions management is permitted to make. You cannot authorize a comp program expansion when the quarterly interest payment is due in 3 weeks. You cannot invest in staff training when the leverage covenant requires you to maintain a specific debt to EBITDA ratio. You make the decisions that service the debt, and you make them at the expense of everything that does not directly service the debt, which eventually includes most of the things that made the casino worth visiting in the first place. By 2015, the weight of the debt that Apollo and TPG had loaded onto Caesars was impossible to sustain. The company filed for Chapter 11 bankruptcy protection in January of that year, in what was at the time one of the 10 largest corporate bankruptcies in American history. The bankruptcy proceedings were extraordinarily complex and contentious, involving years of litigation between different classes of creditors who were all trying to extract the maximum possible value from a company that had been deliberately structured to make such extraction difficult and to obscure the flow of assets between different legal entities within the corporate structure. The legal battles that resulted have been studied in business schools and law schools as examples of the lengths to which sophisticated financial actors will go to protect their positions in a distressed capital structure. What they have not been studied as, though they should be, is examples of what happens to the customers of a hospitality business when that business becomes the subject of multi-year bankruptcy litigation. The answer, in the case of Caesars, is that the customers experienced something that felt like watching a beloved institution slowly decide it no longer needed to try, because it didn't. When you are in Chapter 11 bankruptcy, your legal obligation is to your creditors. Your practical obligation is to generate enough cash to satisfy the bankruptcy plan. The obligation to your customers, the obligation to maintain the quality and value of the product that made them loyal in the first place, is subordinate to all of that, and everyone in the organization knows it. Caesars emerged from bankruptcy in 2017, and the company that emerged was not the company that went in. It was acquired by Eldorado Resorts in 2020 inches, a transaction that kept the Caesars name but brought in an entirely different management culture. Eldorado was a regional casino operator, profitable and well-run in its own context, but built in and for a completely different market than the Las Vegas Strip. The executives who ran Eldorado had built their careers running properties in markets where the competitive dynamics and the customer expectations were entirely different from what the Strip represented. They looked at the Caesars portfolio and saw costs. The Total Rewards program, which Gary Loveman had built into the most sophisticated customer loyalty operation in the industry, was a cost. The diamond lounges at every property were costs. The dedicated host program was a cost. The free parking, the room upgrades, the quarterly celebrations, the birthday stays, all costs. The analysis was not wrong. They were costs. What the analysis missed or chose to ignore was that they were costs that purchased something real. The loyalty of a customer base that had been choosing Caesars properties over alternatives for decades based on the specific value those programs delivered. The MGM story is parallel but distinct, and in some ways more revealing, because MGM's transformation was not driven by bankruptcy, it was driven by choice. By the deliberate decision to use the casino real estate portfolio as a vehicle for financial engineering of a different kind. In 2016, MGM Resorts created a real estate investment trust, a REIT called MGM Growth Properties, and transferred the ownership of most of its major casino properties into that entity. The REIT then leased those properties back to MGM Resorts. What this accomplished was a separation of the real estate from the operating business that generated an enormous immediate cash infusion for MGM, unlocking the capital value of the buildings, while obligating MGM to pay rent in perpetuity on the properties it had previously owned. The financial logic was sound, in the narrow sense that it generated short-term capital and created tax advantages associated with the REIT structure. The operational consequence, which was entirely foreseeable and was certainly foreseen by the people who structured the deal, was that MGM Resorts became a tenant in its own buildings, paying rent to a landlord whose sole interest was the receipt of rent payments. MGM Growth Properties was subsequently acquired by Blackstone Real Estate, one of the largest real estate private equity operations in the world, for approximately $17 billion. And Blackstone, to be absolutely clear about this, is not a hospitality company. Blackstone does not care whether the player at the Bellagio feels appreciated. Blackstone cares whether the rent arrives on time. That is its fiduciary obligation to its own investors, and it fulfills that obligation with considerable competence. The question of how MGM Resorts treats its customers is not Blackstone's question. It is MGM Resorts' question, but the answer MGM Resorts is able to give is constrained by the rent obligation it now carries, and that constraint flows directly and inevitably down to the operating budget and then to the floor. and then to the experience of every player who walks through the door. This is the mechanism that most people who complain about what Las Vegas has become do not fully understand. The resort fees and the parking fees and the degraded comp programs and the 6-to-5 blackjack are not arbitrary decisions made by executives who woke up one morning and decided to be cruel. They are the predictable output of a specific financial structure that was imposed on these businesses by the ownership changes of the past 2 decades. When you load a casino company with debt or obligate it to pay rent on the buildings it operates, you change the math of every decision made inside that building. A free hotel room that used to cost the casino $40 in foregone revenue now has to be measured against a rent obligation and a debt service requirement that didn't exist when the company owned the building outright. The $40 cost is the same, but the context in which that cost is evaluated has changed entirely. In the old context, that $40 comp purchased customer loyalty worth thousands of dollars over a lifetime of visits. In the new context, that $40 comp is a reduction in the cash available to service the debt or pay the landlord, and the financial model does not automatically account for the long-term value of the loyalty it purchases because the financial model is optimized for a time horizon that is shorter than the time horizon over which loyalty actually pays out. The people who made these decisions are not villains in the conventional sense. They are rational actors operating within a system of incentives that rewards short-term margin improvement over long-term relationship investment. The private equity fund manager whose carried interest is tied to the performance of the fund over a 10-year investment horizon has no incentive to worry about whether the casino's comp program will generate customer loyalty in year 15. The REIT, whose obligation is to deliver consistent rent payments to investors, has no incentive to care whether the tenant casino's hospitality culture is degrading. The bankruptcy court, whose mandate is to maximize value for creditors, has no incentive to protect the quality of the customer experience. Every individual in this chain is behaving rationally according to their own incentive structure. The problem is that the sum of their rational individual behaviors produces an outcome that is irrational from the perspective of the industry's long-term health, and catastrophic from the perspective of the customer who built 30 years of loyalty around institutions that are now structurally incapable of honoring the relationship. Let's talk about the people, not the financial structures, not the debt ratios, not the REITs. The actual human beings who used to work in Las Vegas casinos and whose jobs and whose professional cultures represented the delivery mechanism for everything that made the strip worth visiting. The pit boss, who had worked the same floor for 20 years and knew every regular by name and game and drink preference. The casino host, who maintained personal relationships with hundreds of players across the country, who knew when their regular clients had birthdays and anniversaries, who sent handwritten notes and made personal calls and had the discretion to comp a suite or arrange a reservation because they understood the value of the relationship they were maintaining. The dealer who remembered your favorite side bet and asked about your kids, the cocktail server who knew you drank bourbon and brought it without being asked. These people were not incidental to the Las Vegas experience. They were the Las Vegas experience. The physical infrastructure, the buildings, the games, the lights was the backdrop. The people were the content. When private equity acquires a hospitality business, one of the first things the new ownership examines is the labor cost structure. Labor is typically the largest controllable expense in a hotel casino operation, and it is therefore one of the first targets for optimization. Optimization in this context is a euphemism for reduction. Experienced hosts who have been with the company for 15 years earn significantly more than entry-level employees. They also have institutional knowledge that is difficult to quantify on a spreadsheet, which means that when a spreadsheet-driven optimization exercise identifies them as high-cost resources, that knowledge is often not properly valued in the analysis. The result, repeated at multiple properties across the MGM and Caesars portfolios during the cost optimization initiatives of the post-2015 period, was a wave of departures of experienced hospitality professionals whose relationships with the player base were not transferable assets on the balance sheet, but were nevertheless the mechanism by which the casino retained its most valuable customers. The players those hosts had managed followed them. Some followed them to competitors. Some stopped coming to Las Vegas at all. The replacement of experienced human judgment with automated systems was another consequence of the same optimization mindset. The electronic drink monitoring systems installed at video poker bars in multiple strip properties, the sensors that track your coin-in rate and your denomination and cut off your complimentary beverage if you're gambling. Intensity. Falls below an algorithmically determined threshold are the most visible symbol of this substitution, precisely because they are so viscerally insulting to anyone who understands what they represent. They represent the conversion of a human hospitality gesture into a transactional output of an optimization algorithm. The cocktail server who used to decide, based on her reading of the room and her knowledge of the regulars, when and whether to bring a drink, has been replaced by a sensor that makes the same determination based on a formula that has never been introduced to you, that doesn't know you've been coming to this property for 12 years, and that processes your immediate betting behavior as the only relevant input. You are not a customer to the sensor. You are a data point. The call center model that now routes calls from guests at major Caesars properties to centralized customer service operations, rather than to the actual front desk of the property where they are staying, represents the same logic applied to the relationship between guests and the hotel. The experienced front desk staff member at a large Las Vegas hotel who knew the property intimately, who could call the housekeeping supervisor directly, who could authorize a room move or a late checkout or a restaurant reservation in seconds because they had the authority and the relationships to do so, has been replaced by a call center agent who has none of those things. The call center agent will file a ticket. The ticket will be assigned to someone at the property. The ticket may or may not be resolved before checkout. The service outcome is worse. The guest experience is worse. The operational efficiency, measured in labor cost per call handled, is better. The optimization has been accomplished. The relationship has been damaged. The broader labor picture at Las Vegas casinos during this period is documented in the news coverage that Florian referenced in the first video. Mass layoffs during the pandemic were expected and comprehensible. What was less expected and less comprehensible was the extent to which those layoffs were structured to not bring everyone back. Casino companies used the pandemic-mandated closure period as an opportunity to restructure their labor models in ways that reduced their long-term exposure to experienced, senior employees. The union negotiations that followed the reopening were among the most contentious in the history of Las Vegas labor relations, and the settlement that workers eventually won represented a significant victory in terms of pay, but could not fully address the cultural and institutional knowledge that had been lost during the period of mass displacement. The Las Vegas you see today has a labor force that is, on average, less experienced and less institutionally connected than the Las Vegas of 2019. That loss of experience and institutional connection shows up everywhere in the guest experience, in ways that are difficult to measure but impossible to miss. The visitor numbers are the final, definitive accounting of what all of this has cost. Las Vegas posted its sharpest annual visitor decline outside the pandemic period in 2025, with visitation falling approximately 7.5% year over year. In absolute terms, that represents millions of fewer people visiting the Strip. The revenue per visitor remained relatively high because the visitors who came were spending more. The casino revenue model that emerged from the private equity era is explicitly designed around this dynamic. Extract more from fewer visitors, replace quantity with intensity. This is what the resort fees accomplish. This is what the dynamic pricing on hotel rooms accomplishes. This is what the removal of affordable table minimums accomplishes. You lose the budget traveler, the middle-class regular, the player who would come 4 times a year for a weekend and spend a reasonable amount, and you replace them with a smaller number of high-spending visitors who are mostly there for the spectacle rather than the game. The math works in the short term. The problem is that the budget traveler and the middle-class regular were also the people who told their friends about Las Vegas, who brought their families to Las Vegas, who organized group trips to Las Vegas. who became the cultural ambassadors of the city's appeal. When you lose them, you lose not just their direct revenue, but the word-of-mouth engine that sustained Vegas's reputation for accessibility and value across the middle of the American economy. The international tourism dimension adds another layer to this collapse that the pure financial analysis misses. For decades, Las Vegas was genuinely aspirational to international visitors, particularly to Canadians, Europeans, and visitors from Latin America and Asia, because it represented something unavailable in their home markets, the American entertainment spectacle at its most concentrated and accessible. The 32 million Canadians who live within driving or short flying distance of Las Vegas were historically among the most reliable and highest spending international visitors to the city. In 2025, with visitation from Canada falling dramatically in response to geopolitical tensions and the genuine shock of the border relationship between the United States and Canada deteriorating, Vegas found itself scrambling to win back a market it had spent 20 years taking for granted. The image of the Las Vegas mayor going on national television to personally appeal to Canadian tourists to please come back is not a detail from a satirical novel. It actually happened. And the response documented in a Reddit thread with nearly 4,000 upvotes, in which Canadians responded to that appeal with a collective and emphatic "not a chance," tells you everything about the state of the relationship between Las Vegas and the customers it spent years mistreating. But here's the thing that separates what is happening to Las Vegas from a simple story of corporate greed and its consequences. The story is not over. The decisions made by private equity firms and REIT structures and cost optimization consultants are not irreversible laws of physics. They are business decisions, and business decisions can change when the business conditions that motivated them change. The visitor decline of 2025 has already begun to produce exactly the kind of defensive promotional behavior that you would expect from companies that are watching their revenue drop. Room rates are softer than they were 2 years ago. Comp offers are being extended more aggressively. Some properties are experimenting with restoring benefits that had been cut from loyalty programs. None of this is philanthropy, and none of it reflects a genuine change of heart about the relationship between the casino and the customer. It reflects a quarterly earnings number that was lower than the model predicted, and executives responding to that number with the tools available to them. The more fundamental question is whether the ownership structure that drove the original degradation has changed. The answer is that it has not, at least not in any way that would alter the basic incentive alignment problem. MGM Resorts is still paying rent to VC properties on most of its major Las Vegas casino assets. Caesars is still carrying debt and still operating under a management culture shaped by the Eldorado acquisition. The private equity firms that shaped these companies during their critical transformation decade have mostly realized their positions, meaning they have sold their stakes and taken their profits and moved on to other investments. But the structures they created, the REITs, the debt loads, the cost-optimized operating models remain in place and continue to generate the same pressures on the same decisions that affected you the last time you were in Las Vegas, and something felt wrong. What has changed is the competitive landscape, and this is where the story becomes genuinely interesting for anyone who cares about where to go and who to give their business to. The competitive landscape of American casino gaming in 2026 looks nothing like it did in 2006. And the change is almost entirely favorable to the serious player who is willing to do the work of understanding which operators are still running their businesses on the original philosophy and which have been absorbed into the private equity paradigm. The Fontainebleau Las Vegas, which opened in late 2023, is the most significant competitive development on the Las Vegas Strip in years, precisely because it operates outside the MGM Caesars duopoly and has a specific incentive to compete for the middle market player that the duopoly has been actively discarding. The Fontainebleau's loyalty program launched with achieve rates and benefit structures that deliberately recalled what the major programs offered at their peak, because the Fontainebleau needed to establish a player base and understood that the way to establish a player base is to give players a reason to switch. The Wynn and Encore properties have similarly maintained a hospitality culture that is measurably more attentive and genuinely more player-friendly than the corporate monoculture of the Strip's two dominant operators, and they have maintained it because the Wynn organization's ownership structure and management culture have remained more insulated from the private equity logic than their competitors. VC Properties is Wynn's landlord for some assets, but the relationship there is different in important ways from the MGM Blackstone dynamic. Off the Strip, the competitive advantages available to the serious player are even more pronounced. Downtown Las Vegas, anchored by the Circa and the D and the Golden Nugget, operates on a fundamentally different economic model than the Strip. The downtown properties do not carry the same rent obligations or debt service requirements. They compete directly with each other for a customer base that has genuine alternatives, and they have maintained practices 3-2 blackjack on main floor tables, lower minimums, real comp programs with achievable thresholds that the Strip abandoned years ago. Circa, specifically, which opened in 2020 as a property designed explicitly for sports bettors and serious gamblers rather than the tourist and spectacle market, has become a significant gathering point for exactly the kind of player that the Strip's corporate operators have been systematically alienating. Beyond Las Vegas, the migration of serious gambling action to alternative markets that this channel has previously covered in detail, Reno, Atlantic City, Biloxi, Laughlin, New Orleans, is not a fad or a temporary response to temporary conditions. It is a structural reallocation of player loyalty driven by the rational recognition that these markets offer better value, fairer games, more genuine hospitality, and an operating philosophy that still treats the player as the reason the building exists. The players who have made this migration are not going back, and each year that the Strip's dominant operators maintain the ownership structures and operating philosophies that drove the alienation, the migration becomes more permanent and the cost of reversing it becomes higher. There is a specific and I think important distinction to be made between what private equity did to Las Vegas and what private equity is sometimes correctly credited with doing in other industries. In many contexts, private equity ownership genuinely improves the companies it acquires by forcing operational discipline, eliminating waste, and professionalizing management. The casino industry is not one of those contexts, and the reason is fundamental to the nature of the casino business. A casino is not a manufacturing operation that can be made more efficient by reducing labor and optimizing supply chains without affecting the quality of the output. A casino's output is an experience. The experience is produced by people, by the interactions between those people and the customers, by the physical environment those people maintain, and by the policies and practices that govern how those people are permitted to treat the customers. You cannot optimize the cost of producing that experience without degrading the experience itself, because the experience is the product and the people who deliver it are the production line. When private equity applies its standard toolkit to a casino, reduce labor costs, increase prices, eliminate underperforming amenities, load the balance sheet with debt to amplify returns, the result is not a more efficient casino, it is a worse casino. The efficiency gains are real, the product degradation is also real, and in the specific market that Las Vegas competes in, the product degradation eventually costs more than the efficiency gains earned. That is the lesson of 2025's visitor numbers. That is the lesson of the Caesars bankruptcy. That is the lesson of every mass layoff and loyalty program, devaluation and parking fee introduction, and free drink sensor installation. You cannot build an empire by disrespecting the people who built it. Las Vegas built its empire on an agreement. The terms of that agreement were simple and human. We will take care of you, and you will keep coming back. And in the aggregate, across millions of visitors and decades of visit, the house edge will do the rest. The agreement worked, the empire was built. And then the financial engineers arrived and decided that the agreement was inefficient and the human element was an uncontrolled cost and the relationship was a liability that could be converted into margin. They were wrong. The visitor numbers prove they were wrong. The empty restaurant seats and the casino workers begging for shifts prove they were wrong. The 4,000 upvote Reddit thread of Canadians telling the Las Vegas mayor where he can deposit his tourism appeal proves they were wrong. The soul of Las Vegas did not die. It relocated exactly as this channel said it did. It went to Reno and to Atlantic City and to Laughlin and to Biloxi and to New Orleans and to every other market where the people who run the casinos still understand that the player sitting at the table is not an obstacle to profitability, but the reason profitability exists. The private equity firms took the buildings and the brands and the balance sheets. They could not take the philosophy because the philosophy was never on the balance sheet. It lived in the culture, and when the culture was destroyed by 2 decades of financial engineering, the philosophy simply moved to wherever the culture survived. The casinos that still have it know they have something precious and compete accordingly. The casinos that lost it are now competing on price promotions and begging Canadians for a second chance. The question this channel is going to keep asking, trip after trip and video after video, is simple. Who still deserves your money? Who still runs their casino on the original philosophy? Who still sees you as a guest rather than a revenue unit? Who still operates on the handshake rather than the spreadsheet? The answers exist. The places exist. The experiences exist. They are just not always where you used to find them. And finding them, documenting them, telling you exactly where they are and what they offer and why they deserve your action instead of the strips, that is exactly what we are here to do. My name is Florian, this is Flick. If this video explains something you have been feeling but couldn't fully name, share it with someone who needs to hear it. And if you have been to a property recently that still does it right, that still operates on the old philosophy, tell me about it in the comments. Because the story of what Wall Street did to Las Vegas is not the end. It is the beginning of the question about what comes next. And the answer to that question is being written right now, one player at a time, by every person who decides that their money and their loyalty belongs somewhere that actually earns them. See you at the next one.